Talk Money.
Hello and welcome to Let's Talk Money. Here's wishing all of our viewers a very, very happy Diwali. This year has been a gracious one with markets doing well and investors getting plenty of opportunities to create wealth. So what does the new Samvat hold in store? What do you need to keep in mind as you look at your portfolios as well as your overall financial well-being? Well, that's the theme of this Diwali special. I'm your host, Surabhi Upadhyay, and helping us get on that path to prosperity in the new year, we have with us Radhika Gupta of Edwelweiss AMC as well as Ashish Shanker of Motilal Oswal Private Wealth. Lady and gentlemen, thank you very much for joining in. First of all, happy Diwali to both of you. And I want to start by saying a thank you because you've been partners in the wealth creation journey over the last 1 year and the last many, many years. So happy Diwali, Radhika. Opening thoughts.
Happy Diwali to you, Subhi, Ashish, all your viewers. I think opening thoughts, there should be a lot of gratitude for the last 1 year of Samvat. I think I was looking at mutual fund numbers. You look at any category of funds, returns are 40%, 50%, 60% on a 1 year basis. I think the Indian economy has never looked better from a macro standpoint. I think it was a year where I say that if there was a movie theme to define the year, it would have been Swades. Because in a period of such relentless FII outflows, we've seen such strong retail participation, such strong consumer confidence into our own equity markets. So I think the word to sum up the Samvat should be a lot of gratitude for what we've got.
I think that's beautifully put, and it's something that investors must keep in mind. We need to start with gratitude. Completely agree with you on that. Ashish, your thoughts?
Yeah, so happy Diwali to you, all the people at CNBC and your viewers. I completely echo Radhika's thought on gratitude. I think it's been an amazing year. And, you know, sometimes we forget the mood we were in last year and we look at near-term developments. If you look at last year, the same time, we started in a situation where there were geopolitical tensions and we almost thought there's going to be a third world war. You had planes flying over Taiwan, so on and so forth. So considering where we started, I think this year has been spectacular. I mean, the index itself on the equity side has done about 28%. And like Radhika said, you've had schemes which have done 40, 50%. And the best part, Surabhi, is that all asset classes have shown. It's not just equities, right?
Correct.
Gold has glittered again.
30% gold.
Absolutely.
Who would have thought?
Gold has glittered again. Fixed income has done reasonably well because interest rates have come off. So really, we have no reasons to complain. So a lot of gratitude. And we should go cheerful into the next Samvat.
No, absolutely. You know, I completely take your point as well. But that's the thing, Ashish. You know, you spoke about planes flying and the planes are still flying. It's a question of now whether you're talking about the Middle East or it's still Ukraine. And there are still a lot of risks out there. The fact that markets have managed to climb all these walls of worry and mountains of worry, I mean, does it sort of make you a bit nervous? Or do you think there's been good reason behind the rally and behind the buoyancy that we've seen this year?
Yeah, so obviously there's very good reason behind the rally. And like Radhika said, you know, our economy is looking in extremely good shape. And I think this will be the 5th year consecutive double-digit earnings growth for the Nifty. It has never happened in our history, including 2003 to 8. So there is a lot of good news which is translating into this market returns. There are risks on the horizon. I mean, some of the geopolitical tensions have continued to linger. And then you have the big one, which is the US elections, you know, in 10 days' time. I believe that once that is behind us, things will settle down. But having said that, given the situation where we are in, and that's the reason, you know, I think we had met probably a month and a half back, and I'd echoed this thought that, you know, people should go into this Samvat with a balanced portfolio.
Correct.
Right? Whilst things have been extremely good, but there is no reason to be carried away. So there are two things I would advise. One is moderate your expectations. You know, what has happened in the last 2-3 years is very difficult to replicate in the next 2-3 years, although the next 2-3 years look pretty good from an equity point of view. But at the same time, the risks are lingering on the horizons. So have a balanced portfolio and continue to have some gold in the portfolio. I mean, gold has obviously glittered. Maybe the returns on gold moderate, but I think you look at gold now as a risk or an insurance to any untoward happening at the global level or even in India.
That's typically how it should always be looked at, right? But it's become a, you know, asset class in its own right. People look at gold for now, you know, generating more wealth, not just sort of to hedge their portfolios. That's been a new thing. And we'll come back to gold and we'll talk more about it. But Radhika, the story of the, you know, the Indian retail revolution, that's been Absolutely phenomenal, right? What are your thoughts? We've spoken several times through the year on this 35, 40,000 crores that keeps coming into mutual funds month after month. And what now? Because we speak at a time where this is the first, so to speak, test for equity investors where markets have not been going up in a straight line.
I travel the country a lot, especially now increasingly because of our expansion to tier 2, tier 3. And one, I think everybody understands the equity story. In fact, I often think we underestimate sort of the confidence even in tier 3 and tier 4 India and the interest in mutual funds. I mean, I'll go to a tier 3 or tier 4 town where there's no airport connectivity, but thousands of people will show up for an equity meet. So I think the India equity story is a structural story. Month on month, when the SIP numbers come out, there's almost a sense of surprise. Oh, they're 20,000, or they're 22,000, or they're 25,000. I do believe you will see in India not far from now where you have a 1 lakh per month crore SIP book. So I think that is a realistic possibility because financialization is genuinely just about to start. Now, as far as correction, of course, we've had a lot of new investors come in after COVID. I think seasoning of investors is a natural process. We had seasoning of investors who came in 2006 and 7, learned some hard lessons in 2008 and have become wiser. I do think net-net the Indian retail investor is acquiring wisdom. When markets fall, people are adding. People aren't closing down SIPs. There's a lot of awareness. Yes, there are the old mistakes that are repeated. So my theme for the year has been Dal Chawal. In a year when 50% of the money comes into thematic funds, the idea is to move people into the middle path, tell them not to do too many exotic things. So that will happen. But finally, I think consumer confidence in equities is here to stay. A little bit of moderation needs to happen.
Okay, so now let's get to the task at hand, and that is to try and ensure that we remain on the path of prosperity. Come what may, markets can go up and down, but it's our job to ensure that we are very systematic and hygienic and disciplined when it comes to our portfolios. So, Ashish, let's straight away get to it. Like you said, yes, even earlier this year, you have had a tilt towards more balanced strategies. It's not like full whole hog into equities anymore, right? Tell us why.
Right. So one of the reasons, Surbi, is that, look, it's 3 years into a bull market, right? I do believe valuations are not super expensive, but at the same time, they're not cheap. They are probably in the reasonable zone. There are pockets of exuberance which investors need to be wary of. And like Radhika said, a lot of money coming into thematic funds. And some of the thematic funds have fallen about 25-30%. So I think people have got a wake-up call. Whilst we continue to remain bullish on equities, I think there are risks lurking in the background, whether it's in terms of geopolitical tensions or in the near term, earnings slow down. I mean, we saw this quarter, I think the downgrades were more than upgrades. So these things happen in the midst of a bull market. So as a result, I think having a balanced portfolio just helps smoothen the ride. So equities is one asset class which clearly we continue to be bullish on, albeit with moderate expectations. Gold, we continue to be positive on for different reasons. I mean, we were bullish on gold as an asset class maybe a year back, and we believe gold will perform well. It has done extremely well. But expecting gold to deliver these kind of returns year on year is very difficult. So I think gold now takes the original role of a protector in the portfolio, right? So if something goes wrong on the global front, then gold tends to shine, and it also gives you the much needed firepower to rebalance. One should look at fixed income because, given where equity markets are and the way gold has rallied, fixed income gives you that cushion in tough times. So having a little bit of fixed income, and we do believe that interest rates will go lower in India, and even globally, that's the stance of most of the central banks. So if that happens, you can get a little bit of upside. And for people who have larger portfolios, structured debt, etc., is emerging as an attractive option to enhance the yield in the portfolio.
So let me ask you, if you were constructing a portfolio from scratch today for a medium risk investor, how much of each? I mean, how much equity, debt, fixed income?
Yes. So I would continue to be, more exposed to equities because when I talk about medium risk investors, somebody who's 30 to 40 years of age, I think equity still stands out as an asset class because you're still in the wealth creation stage of your life, right? So about 50 to 60% would still be equities. I would say 10 to 15% in gold, like I've always messaged. And the remaining portion could be in debt. And some part I always believe should be in cash as an emergency reserve, because that just helps you tide out volatilities in the market.
Okay, fair enough. So that's a good starting point, because we have a basic sort of construct that each one can keep in mind. But Radhika, I want your thoughts on a point that Ashish raised on thematic funds, and that's been the biggest trend of the mutual fund industry this year, right? There have been funds on defense, funds on consumption, funds on, any and every theme that you can perhaps even imagine. Now, what are your thoughts? Because in some cases, when the themes are extremely niche and narrow, like PSU or defense, the drawdowns and the fall in stock prices has been severe as well. So will this scare away people, or do you think the investors have matured enough? Your thoughts on thematics?
So I don't have a problem with thematic funds, but I think our definition of thematic funds has, evolved to be too narrow. In the old parlance of mutual funds, thematic funds used to be things like financials or consumption or manufacturing or tech. And so these were broad-based sectors, And even when these kind of thematic funds existed, my view was that these should be the satellite part of the portfolio. So if 80% of the portfolio is some combination of the things that Ashish mentioned, multi-cap equity, fixed income, gold, silver, international, then 20% was allocated to these thematic funds, and that is well and good. The problem now, and where I really get nervous, is the extremely narrow thematic funds. And I always tell investors to do a couple of checks. Check one is exactly how narrow the sector is. So historically, we've seen retail investors, and in fact, all investors don't do the best job timing themes. I mean, last year, if you looked at the 10-year returns of PSU funds, it was single digits, less than 10%. You had a huge rally, a lot of funds were launched, and then, the numbers look great. So people don't do a great job timing. Don't do very narrow themes, and where you do themes, stick to that satellite part, and then I think people should be okay.
Okay, all right. So I think that's a good way of approaching the whole thematic space if it is something that you want to dabble in. And I guess, Ashish, you want to add to that, because we always hear about this core and satellite approach, right? So overall, would you keep thematics in a portfolio, and if yes, you'd limit them to what percentage, and what themes are you convinced on?
See, thematics by definition are for a little more sophisticated investors. I mean, let's say you're bullish on a particular sector and you don't want to spend the time researching on stocks, then you can go and buy a thematic fund, right? Or if you're a contrarian investor and a particular theme is not done well for the last 3 to 5 years, then you could take a contrarian allocation to that particular thematic fund. So I believe that, a certain portion of the portfolio can go into thematics, but like Radhika mentioned, a broader theme always helps. So for example, a year back, I think pharma as a theme had not done too well, and we were messaging that this is a sector which is ripe for re-rating, and you could have gone and bought a pharma fund. And pharma is a much wider theme. Similarly, for example, IT services, digital is a much wider theme, and those stocks have underperformed until three months back. Most of these stocks had derated. And we continue to be bullish on that particular sector. So, you have a core portfolio which consists of flexi cap, mid cap, small cap funds. And then you probably have 20-30% where you're trying to also apply your expertise. So, for example, if someone is working in the IT sector and you believe you know the IT sector extremely well, and you want to apply that thought to markets, it's not a bad idea. I mean, you could go out and do that.
Okay, all right. So that's some advice on thematics. Good to keep that in mind. We do have to take a very, very quick break. But when we come back, we dive a little deeper into the perfect portfolio creation for the new Samvat. Back in just a moment.
Let's talk money